But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
So, and I said, well, what if it does happen? And he says, well, price will solve everything. I said, thanks, give me the gold.
Why do central banks hold it? Well, it's a form of reserves. So why don't they hold diamonds? Well, it's tradition, long-term tradition.
Well, some people still think it's money.
For the EFT, Mr. Bloom has 2 minutes.
Commissioner, Mr. President, I rise again, I'm afraid, to make the same old hoary speech that I've been making here for several years, and that is, it is my opinion that you do not really understand the concept of banking. All the banks are broke. Bank Santander, Deutsche Bank, Royal Bank of Scotland, they're all broke. And why are they broke? It isn't an act of God. It isn't some sort of tsunami. They're broke because we have a system called fractional reserve banking, which means that banks can lend money that they don't actually have. It's a criminal scandal, and it's been going on for too long. To add to that problem, you have moral hazard, a very significant moral hazard from the political sphere. And most of the problem starts in politics and central banks, which are part of the same political system. We have counterfeiting, sometimes called quantitative easing, but counterfeiting by any other name. The artificial printing of money, which if any ordinary person did, they'd go to prison for a very long time. And yet governments and central banks do it all the time. Central banks repress the amount of interest that rates are, so we don't have the real cost of money. And yet we blame the real retail banks for manipulating LIBOR. The sheer effrontery of this is quite astonishing. It's central banks that manipulate interest rates, Commissioner. And plus, underneath all this, we talk loosely, in a rather cavalier fashion, do we not, about deposit guarantees. So when banks go broke through their own incompetence and chicanery, the taxpayer picks up the tab. It's theft from the taxpayer. And until we start sending bankers, and I include central bankers and politicians, to prison for this outrage, it will continue.
Grazie per il gruppo.
Welcome back to the Junius Maltby channel. I'm glad you could join us this evening. It's absolute chicanery that we see these things taking place among banking and politicians. Yes, I'm glad you could join us. And if you have to, rewind it and watch that clip again and again. Mr. Bloom hits the nail on the head. I wish there was more in politics, more in government, speaking out the way he does. He gave that speech there in Parliament, I believe it was 2013. And it really is an eye-opener, a mind-blowing statement, because we have people like him speaking truth in the halls of power. He's speaking truth to power, just like the principles here on this channel, and yet they seem to go unheard. And the entire system continues on with the chicanery. I love that word. I think I should start using it more. I think we need to implement the word chicanery into our everyday vocabulary. It's a good one. And they're using schemes to get these political ends. It's dishonest schemes, conspiracies even, are being exercised by the Fed, by the Treasury, by these central bankers. And like he said, it will continue unless these people go to jail, because what they're doing is wrong. It is theft. It is criminal. It's counterfeit. Fractional reserve banking is counterfeit. But the system survives and it thrives on it. Their theft depends upon it. So today's discussions are going to be on this continued exercise and method of theft that seems to be unimpeded, celebrated, and if anything encouraged continually by everyone in the European Union and even here in the United States and in governments around the world. We're going to take a look at some of them. I've got several articles pulled up, and we're going to look at how we, again, navigate these waters. How do we survive such an environment? So join me here on this channel, the Junius Maltby channel, for another extemporaneous, unscripted rant on these very topics. You know, headlines abound, like this one. Fed may be stuck with forever stimulus as exit from QE, quantitative easing, impeded. This is a recent article from October 19th, and it has an image there of the bulging balance sheet of the Fed pumping trillions of dollars into the economy. And this is what he was talking about. This is, for no other definition needed, this is counterfeit. They just counterfeit money, producing it out of nothing, and expand the balance sheet, expand the money supply, devaluing the currency that exists out there. Robbing you and I and everyone who holds these currencies, is paid in these currencies, or depends upon buying goods and services in these currencies. Fed balance sheet hits new record high as QE takes the spotlight. This is from October 22nd. Again, another recent article. The Federal Reserve's balance sheet inched up to a record $7.18 trillion as of Wednesday, with all signs pointing to further growth in the central bank's portfolio. The Fed's outright holdings of U.S. Treasuries and mortgage-backed securities, if you remember what those are, added about $25 billion to $6.65 trillion over the last week. Articles regarding quantitative easing permeate the news cycle. They come out almost every other day or every day. Does a big bazooka matter? Quantitative easing policies and exchange rates. This one from October 20th. Question: can you quantify the effect of quantitative easing? Twitter chatter about QE forever may soon become a reality, but what will it mean for the markets? This is from October 21st. Are emerging countries playing with fire? Quantitative easing can have negative effects on developing markets. This one has kind of a a privilege and I would even say racist connotation to it, because what they mean by the emerging countries is the smaller, darker, or browner ones. Their economies, if you've noticed, we've talked about this in the past, they are frowned upon when they try to do the same things that larger nation states like the United States or even the European Union, England, when they try to do those same banking policies, again, quantitative easing, they accuse them of playing with fire or destroying their economies. And you've seen that with places like Venezuela, Zimbabwe, many of the smaller nations that do some of the same things end up having runaway inflation and their economies implode. So this article here discusses that, and I want to show you some charts that are found in this article. They're actually interesting. The COVID-19 pandemic marked a turning point for unconventional monetary policies in emerging markets, several of which embarked on government bond purchase programs to address market dislocations and ease monetary conditions in the short run. However, debt sustainability and inflation are the biggest risks ahead, especially for Brazil, Costa Rica, India, Turkey, and Hungary. Everything just sounds a little bit more brilliant when you put a British accent on it. So here we derive the inflationary risk score. This is introduction to the next chart, so pay attention to this part. You'll get it once the chart shows up. We derive the inflationary risk score from a set of 4 indicators across the selected EMs, emerging markets. CPI inflation rate and real inflation-adjusted monetary policy interest rate as of July 2020, imported inflation risk, share of fuel and food in total household consumption, and the lagged correlation between money supply M2 growth and inflation. Importantly, the M2 growth accelerated in all 16 selected EMs in the course of 2020, and that is a positive correlation with consumer price inflation, except for the Philippines and Colombia. For the indicator, we chose the correlation with a lag of 2 months. Now, this entire article is discussing these very policies quantitative easing policies when implemented by some of these other countries, these emerging market economies. And I want you to just look at the chart because it kind of breaks down some of the countries they believe are at risk, and you'll see what they mean by that. So if you find yourself in any of these countries or potentially investing in any of these countries, just take a look at this here. It's broken into 4 quadrants. The upper left is low inflationary risk with high debt sustainability risk. Bottom left, low inflation risk, low debt sustainability risk. Upper right, high inflationary risk, high debt sustainability risk. And then lower right, high inflationary risk, low debt sustainability risk. And we'll talk about some of the countries here and what their risks are. We'll just pull a couple from each. But you'll notice, again, we're not emerging markets, the United States, the EU, England, places like that. However, they're exercising some of these same criminal theft-like policies of inflation-driven quantitative easing, this principle that we just saw described as nothing more than counterfeit. And now these countries can do it, and they're not allowed to get away with it because, of course, articles are written, the world economy frowns upon them, and then, of course, eventually they implode or collapse or suffer from inflation. You won't see the EU or America, the Fed, or any of those nations listed on a chart like this or in an article like this. But you'll see here, we'll just go to the very high inflation risk, high debt sustainability risk. And the countries that they have there, which I would consider, they're all red, so this is very high risk, is India, Romania, Hungary, and Turkey. So those are at risk, according to this article here. Now, you've got the Brazil, upper left, low inflationary risk, high debt sustainability risk. And you've got Brazil, Costa Rica, Croatia, Colombia, Indonesia, all up there in the upper left. Again, that's low inflation risk, but high debt sustainability risk. The lower left is Philippines, Malaysia, and Thailand. And that category is the low inflation risk, low debt sustainability risk. We missed South Africa. South Africa was up there. It's in the same quadrant with Brazil. Now, as they're populated on here, you can see the little blue dots representing each country. Some of them are at more risk than others, more closer to the center than others. And you've got South Africa right there kind of in the middle. But it is in that category that with Brazil, Costa Rica, and Croatia that I mentioned earlier, which is low inflation risk, high debt sustainability risk. Now, lower right is the high inflation risk. High inflation risk, but they have low debt sustainability risk. There we can find Poland, Czechia, Chile. So that's this chart here, and I'm not going to go into this entire article. If you want, you can Google it, look it up, but it's just discussing, again, these emerging markets, playing with fire as they try to do some of the same things that some of the bigger kids on the street are doing when it comes to counterfeit.
Central bankers inflate the numbers on QE. Large-scale asset purchases have boosted growth, but maybe not as much as many monetary authorities claim. Quantitative easing has been the great monetary policy experiment of the last decade. And I want you to take a look at the words that they use here. I mean, they're admitting that it's an experiment. And I don't know if that makes you a little upset, but it certainly should if it doesn't. Most central bankers believe that the large-scale asset purchases have boosted growth and lifted inflation during repeated crises. Critics respond that the impact has been trivial, and they point to potential side effects, such as promoting excessive risk-taking and fostering inequality. The available evidence appears to support the optimistic take. But to what extent can we trust these results?
This brings up a really good point, and that's why I put this article in here. You can't trust the results. The people coming up with the results oftentimes depend for their job, their positions, and their tenure as economists, as professors, you name it, on coming up with the results that are desired by the institutions implementing the policies of which results they are studying. And yes, it's an experiment. We've been told that time again. We've seen it. The evidence shows us as such. Bretton Woods didn't end and break down. We just talked about the new Bretton Woods thing the other day. Until 1972-71, it had just started. I mean, it was a brand new experiment itself, post-World War II, after 1945 therein. So it's one failed experiment after another. The only thing proven, the longest lasting situation, was that of sound money principles and honest, sound banking based on sound money. The idea now that we can just print money out of thin air, it's an experiment gone mad. It's truly the definition of insanity, what they're trying to do at this point in time. And this article here discusses the studies that try to look at the results of quantitative easing. Is it even working? Is the experiment, that's what science, you're trying to use the, what is that they talk about, when you're trying to prove a theory, hypothesis. There you go, hypothesis. They have a hypothesis that this might work, so they're doing an experiment and they're trying to come up with test results. We happen to be in the lab. We are the guinea pigs they're testing this on. The entire world economy is at the whims of these insane bankers and economists that are exercising an experiment on us.
A new academic paper casts fresh doubt over the case for QE. Lubos Pastor, an economist at the University of Chicago, and 3 colleagues have parsed about 50 studies looking at the effect of asset purchases on growth and inflation. They found that researchers working in central banks tend to find a larger impact than academics and conclude that central bankers have incentives, such as possible promotions, to be too kind toward QE. The first thing to know about such studies on asset purchases is that measuring their economic aftermath is problematic. It is impossible to tell how the economy would have behaved in their absence and to disentangle the effects of other events that occurred at the same time. So researchers have to make different assumptions and employ a variety of models. These choices have an enormous impact on the results they produce. I am so congested. The economists find that on average, the studies they reviewed show that QE has a positive effect on inflation and growth. This finding vindicates the central banks that have embarked on the monetary policy, a list that includes the U.S. Federal Reserve, the European Central Bank, and the Bank of England.
Economics as a college study really didn't exist before the 1900s. I think it was Berkeley was one of the first colleges in America in 1903 to offer a degree or program for economics. There were various others scattered throughout the United States that began to start up in that time period, 1903, 1920s, and 30s. A lot of them funded, a lot of the curriculums, the ideas, the theories came out of the very people, their minds, and their agendas that were influential in starting central banking in the United States, the Federal Reserve System, and so on. So it was within their interest to kind of create an education sphere that promoted their agenda and their ideas. And that was really all that was essentially broadcast. So again, this makes sense, that these guys would kind of, I would say, steer studies and try to control data and results to show that what they're doing is working, when in fact it most likely is not.
However, they also find that, on average, papers written entirely by central bankers found an impact on growth at the peak of QE that was more than 0.7 percentage points higher than the effect estimated in papers written entirely by academics. This is a sizable difference, considering the effect found on average across all studies was 1.57% at the peak. In the case of inflation, the difference in the effect of QE at its peak between the two sets of papers was more than 1.2 percentage points. Where are you going?
Nowhere.
Central bankers also tended to use more positive language in summarizing their results in abstracts. And Junius is going to continue the next paragraph because I actually cannot do this.
Your cold has just got you too congested.
I can't say certain things.
You gotta blow your nose.
I can't. It's done. There's nothing to blow.
The authors then investigate the reason for these discrepancies. They suggest that career concerns may have played a role and provide some evidence that central bank researchers who found the largest impact of QE had a better chance of receiving a promotion. Now, doesn't that make sense? They're doing their company guys. They're doing their boss's work. If they do studies that show that what the banks are doing is working, they get a promotion. They also show that not all central bankers acted in the same way. Those working at Germany's Bundesbank, which has been a stern opponent of asset purchases in the Eurozone, found smaller effects on output than academics. It's like the old saying goes, if you have 3 economists in a room, you'll have 5 different opinions. It's important to keep in mind, economics is not like a hard factual science. It's not like 2 + 2 is 4. It's not like discovering certain elements on the periodic table. A lot of it is disputed theories and ideas and beliefs that are difficult to be proven and cannot be proven. And oftentimes, we've seen economists have been proven wrong, or their theories, their ideas, and predictions entirely inaccurate and wrong, time and time and time again. We've covered them here on this channel over the years. And oftentimes, I like to beat on old Krugman. You know, he's the guy that prognosticated that the internet would never amount to a hill of beans. It wouldn't be anything. There'd be no wealth to be made out of it. It would serve no economic purpose. It would serve no purpose whatsoever, and it would most likely fizzle out in the early 2000s, and no one would really turn to it or use it for much after that. He had some pretty dire predictions about the internet, and he couldn't have been more wrong. And that's just a testament, I think, to his overall abilities. You know, Krugman's oftentimes wrong about a lot of things. The bug-eyed, bearded prophet of Keynesian economics these days. The paper does have some important limitations. For starters, the number of studies observed is tiny, which makes it hard to reach strong conclusions. It is also possible that academics are incentivized in the opposite direction. A paper saying that QE had little to no impact on growth and inflation goes against the dominant wisdom and therefore could be easier to publish in an academic journal. Academics may also be looking at a narrower impact of monetary stimulus, for example, one that discounts the role of people's expectations. This may explain the smaller set of effects they found. Still, the paper highlights a fundamental problem at the heart of central bank research. From QE to the introduction of negative rates to the impact of bank regulation on lending, central banks often look at the impact of their own policy choices. They provide an exceptional environment for researchers to study these questions, but they must also ensure that their reputation is preserved and their message stays consistent. This problem is even more relevant within the Eurozone, where national central banks jostle against one another as they seek to shift consensus at the European Central Bank. Perhaps the way to truly assess the impact of monetary policy is to read all working papers from a central bank with an open mind and a touch of skepticism. I think that's the most important part. And you're not going to find much more skepticism than anywhere than you would here on this channel. I think most of us, myself included, Mrs. Maltby, are quite skeptical of these elites, the central bankers, the policymakers, the politicians, all of them. The research methods and data are there for anyone to see and double check. If a result is not convincing, it will not pass the test of time. I don't think this experiment is going to pass the test of time, and I think we're going to be fortunate, or I guess you could say even unfortunate, enough to witness the entire house of cards, the whole show, the smoke and mirrors game, come crumbling down around them. Quantitative easing. Now what do? What do? Question mark. to use some grammatically incorrect language. Thank goodness for the internet for giving us that. Will Bitcoin or gold provide higher returns under a quantitative easing environment? Again, no opinions here. We're just going to read through this because there is some interesting points, pertinent points. All of our opinions and our own ideological positions kept in check. Let's just look through it, read through it, and check it out. You guys know my feelings as an advocate and a strong proponent of gold. But this article raises some interesting ideas, observations about how the two are behaving in this quantitative easing environment, because they've really been looked at as kind of the only two escape hatches that people are choosing. Some people are choosing one, some people are choosing the other. Others choose a mix or a hybrid of both. You know, a little bit of Bitcoin, a little bit of XRP or Ethereum, a little bit of gold, a little bit of silver. And I'm not going to harp on any of that, or your choices. I don't really care. You got to do something. The key here, the goal here, is getting out of fiat, escaping devaluing currencies. And this article just kind of takes a look at it, the subject of how the two are performing at present in this environment of quantitative easing, this experiment, if you will. In the face of central bank quantitative easing and resulting currency debasement, 2020 has turned into a modern-day gold rush. Investors are flocking to gold, Bitcoin, and other hard assets to hedge against the damage the ongoing COVID-19 crisis has done to the economy and the overall monetary system. The monetary system that was dying before any of this began. I cannot believe they continue to attempt to blame this little virus for destroying the world economy, when in fact it has been run into the ground for decades at the hands of these very people we've been speaking about. While physical gold bars have been in high demand, prompting prices to rise to a new all-time record of $2,000 a troy ounce, investors have also increasingly begun to look toward the first ever cryptocurrency, Bitcoin, to act as a hedge against any coming inflation. But which of the two assets is the better choice for investors who seek a safe haven outside of the traditional financial system that could suffer continued fallout from the pandemic and the path of devastation it leaves in its wake? Please stop blaming the pandemic. Let's blame bankers. Come on. To answer this, Prime XBT analyst Kim Chua, a former intuitional trader, and market analysis educator, has provided detailed analysis to determine which has had a better track record of success and where investors will be best served if they place their capital. I'm going to interject a little bit of my opinion here because I think it's relevant. Again, keep in mind, Bitcoin has only existed since 2009. It's very difficult to look at that very small sliver of time inserted into the tapestry that is world history and the history of the world economy. You know, we're talking about gold sitting around for 10,000 years. It's not going anywhere. We know that it's going to maintain and continue being a bulwark of holding and protecting people's wealth. Yes, Bitcoin's here. It's probably going to be for a little while. But again, I've outlined for years my assessment of what I perceive as the risks and some of the drawbacks to Bitcoin. I'm not going to interject those here. Those are in other videos, and that's another topic for another time. But just keep in mind, it hasn't been here that long. And so that is something to consider. But comparing the COVID-19 Black Thursday market collapse, this is a part of this article here that points to the big collapse we saw earlier this year. To begin, we'll backtrack to where the velocity of the two assets' uptrends began to pick up in pace post-Black Thursday. On that fateful day, Bitcoin collapsed from $8,000 to $3,500, representing more than a 50% drop on emerging COVID-19 fears. Let me interject here. At that time, I mentioned this the other day when I did that Bitcoin, state of crypto video. A lot of people called for it it was done. They thought that was it. They really truly believed that we were witnessing and saw the end of Bitcoin. And I don't know how they believed it. I didn't have that suspicion or that fear at all. I didn't believe it was going to die then. If it didn't die during the Mt. Gox collapse when it dropped down to 1.2 cents, a penny, from, I believe it was, $3 to $5? Was it around 5 or 15 that evening when Mt. Gox collapsed? Doesn't matter. It fell significantly and it flatlined. It was in an asystolic period for about, I think, 24 hours. It hovered around a penny, 1.2 cents. This drop to $3,500 was significant. Anytime an asset drops 50%, that's a big deal. At the same time, gold fell a mere 13.72%. Now that's big. That's kind of a shockwave for some people. A lot of people looked at gold as falling 13.72%, and of course the bears came out applauding that and thought it was a good thing. But 13.72%, that's when gold fell from $1,700 to $1,450. Pretty good buying period, and I think a lot of you stepped in. I know that triggered a significant response from people who were concerned. They saw what was going on in the markets. They already had their suspicions about what was going on in the world economy. We had already seen in the fall the liquidity problems with banks, the repo market issues, and so gold purchases really accelerated. The problem was delivery, supply shocks. It was difficult to get physical, and we covered that back then. You're familiar with what took place. But gold fell again from $1,700 to $1,450. This data alone would imply that gold is the better choice for investors that value stability and a solid night's sleep. Amen to that. On the other hand, Bitcoin's wild volatility can be a nightmare for investors that haven't experienced it for themselves, especially if gold is their barometer for market movements. But zooming out, Bitcoin's performance far exceeds gold over the last decade. Now, just over the last decade, that's it. Of course, it's only existed for a decade. And despite having crashed 50% in March, Bitcoin rebounded swiftly within a week and is now up considerably more than gold in year-to-date performance. This is what we talked about the other day. It has done exceptionally well, and I think it's going to see a tremendous more upside. I mean, I have no doubts whatsoever that we will see it attain its all-time high of 20,000 again at some point and possibly exceed that. So that was, and despite having crashed 50% in March, Bitcoin rebounded swiftly within a week and is now up considerably more than gold in the year-to-date performance. Gold, after reaching a new all-time high, has 27% growth on the year to show for it. The cool part is with gold, I don't think you have to worry about a 50% retreat from this point at all. I would actually doubt we will see again at any point something like that 13% drop. That's very rare, and I doubt with the backdrop of what we're seeing geopolitically, as well as the global economy, the debt, all the things we've been talking about, this discussion about quantitative easing, you're not going to see gold retreat 13% again. I can't say the same for Bitcoin. I mean, as volatile and chaotic and crazy, as tied to China as it is, the miners, the problems there, all the competition on the scene with other cryptocurrencies, the way that world works, it's insane. 24 hours, never sleeps. You can't rule out a 50% drop on Bitcoin. Yeah, it could drop tomorrow back to 7,000 or 8,000 from where it's at today, from 13. It's 13,100 and something today. And it could plummet back down to 7 in the blink of an eye. But you're not going to see gold drop to 1,000. Not going to happen. I'll tell you that a million times. You're not going to see it drop to 15 again. I think the days of $1,400, $1,300 gold are far behind us. We probably won't revisit those ever again, not in my lifetime anyway. So again, gold's up 27%, so it's kind of a steady, strong, reliable growth. Physical, you can hold it, you can hide it, you can keep it with you, all of those things. You don't need a phone, you don't need a computer, you don't need technology, you don't need electricity, you don't need anything. You just need gold and a gun and a bag of beans. During the same time frame, Bitcoin is up well over 65%, more than double the return over gold. Looking back further to just 2016 alone, gold has only doubled in value while Bitcoin has increased a whopping 28 times over. So that's about, what, 2,800%, something like that? I don't know. It's a lot. It's quite a bit. Yes, Bitcoin has done significantly well for those who got in, and especially if you got in around 2016, exorbitant amounts of wealth were available for those that were, anyone who bought from 2009 up through 2016 who got into that world of Bitcoin is essentially on easy street these days. Safe haven showdown, crypto versus precious metals. The chief reason for Bitcoin faring so much better than gold is due to the asset's fixed supply. Gold also has a scarce, limited supply, making it what's considered to be a hard asset. But there's no telling how much is hidden within the Earth's crust. We have a pretty good idea, and there's not a lot left, and all the easy gold, as we've discussed, has pretty much been gotten. They've found it and they've exploited it. And then they talk about outer space. And technological advancement can more quickly mine gold from the ground. Some of those later factors mentioned, again, they're going to have, I believe, a negligible, if any, whatsoever effect on the supply of gold going forward. Meanwhile, Bitcoin's mathematical design is hard-coded so that no more than 21 million Bitcoin can ever exist. No new coins can be created, and not all are in circulation yet. And of course, millions have already been lost and will never be seen again, as we've discussed. As gold prices increase, miners are incentivized to improve exploration and extraction techniques to produce greater yields and more profits. However, this has a side effect of increasing the gold supply, catching up with demand and stabilizing prices. However, the supply really is difficult to expand at anything greater than about 2% a year. And again, it just relies heavily on natural resources like oil. To do that, human labor, effort, and there's a lot of factors. We've talked about that. The all-inclusive costs per ounce sold, what goes into extracting and refining and producing gold for delivery it's significant. It's much easier to discuss it than it is to actually look at it and actually what takes place. As I've shared with you before, just in the small prospecting and mining that I've done on my own, gold is very, very difficult to get. And it takes a tremendous amount of resources and effort to do it. Eventually, supply outweighs demand, and gold valuations fall until something economically reignites the market cycle again. Bitcoin, on the other hand, cannot be produced any faster, nor can more ever be created beyond the 21 million cap. When demand rises, supply can never increase, causing valuations to skyrocket instead. This mechanic and design have kept Bitcoin climbing in the face of gold throughout most of its history, if you would like to call history 9 years or 10 years. Making matters worse for the gold supply, an asteroid was discovered by NASA that is filled with the precious metal, doing severe damage to its rarity if ever extracted. However, where is that asteroid today, right now? And have they explored the costs of building shuttlecraft and mining equipment to send into space to extract it and send it back? I think they have, and I can tell you this, it far outpaces whatever small amount would be on that asteroid. I'm sure it's not a big one, and I know there's not many asteroids out there filled with gold hurling around in space. There might be some. However, it's quite rare, and it's one of those things that people like to talk about. It's an entertaining, dinner time conversation, but it really isn't based a whole lot in a reality that we're going to see take place. It's kind of asinine, actually. Bitcoin's decade of growth steals the glimmer from gold. Not for me. Gold has long been the de facto safe haven asset historically. Yeah, historically as in 10,000 years. But since Bitcoin's arrival, in the last 10 years, savvy investors began to acquire the cryptocurrency for similar reasons, as well as diversify away from traditional investments. When Bitcoin began outperforming gold, more and more investors decided to hold Bitcoin instead of gold. Let's pause there. Yes, I remember the days, oh so long ago, when it was stated, I'm sure I said it at some point, that Bitcoin would never be one-to-one with gold. No, that's impossible. It can't happen. And yet it did. I was wrong there. But yeah, so you can't call that kind of stuff. I can't call it anymore. I don't know where Bitcoin's going. The two assets are often very closely compared, with Bitcoin acting as the digital counterpart to the physical precious metal. Significantly more people own gold due to its use over the centuries. However, Bitcoin is becoming increasingly popular in the digital age, and with millennials, perhaps one of the most useless generations outside of the Zoomers.
Junius.
What?
You called me a snotty-nosed girl. You married a millennial.
Yeah, you're like the only one that's good, worth anything. Bitcoin is far more divisible than gold, more convenient to store, cannot be counterfeited, and much more. Still, traditional bankers prefer gold over Bitcoin due to its long history as a reserve asset and how it has survived many generations of economic crises and monetary system changes. Not to mention it doesn't drop 50% in a day, really. Many gold bugs, I hate when they use that word, we're gold hawks, get it right, believe gold is the only real money, as currencies like the dollar were one time pegged to gold. The asset has been long considered the gold standard in terms of monetary policy and has never failed in this role. That's a pretty good record when you never fail at something. But with Bitcoin beating gold at its own game, a new champion currency may have emerged. Proponents on both sides of the coin have valid reasons for believing in each asset, but empirical evidence has shown that Bitcoin has outperformed the precious metal ever since it came into existence, and it is likely to continue to do so. The most transparent way to compare the price action of the two hard safe haven assets, I wouldn't call Bitcoin hard, though. It's not even tangible, but that's neither here nor there, even though I hate that term, I'll say it. Is by looking at the XAU BTC chart, the gold Bitcoin price chart. The trading pair plots the progress of Bitcoin price in an ounce of gold. Gold has underperformed Bitcoin from the moment it came into existence, and the cryptocurrency has rarely looked back. The XAU BTC pair has been in a downtrend since 2011. And although it slowed down in Bitcoin's bear market in 2018 and 2019 while gold began to build the foundation for its uptrend, Bitcoin is ready to rip once again. We're going to take a look at that chart and you'll see what they're talking about. So what this chart shows you is Bitcoin priced in gold, how much gold it would take to purchase Bitcoin. And as you can see, it's falling, which means Bitcoin is becoming more valuable as priced in gold. You can get more if you were to sell your Bitcoin. You are able to purchase more gold every time this is dropping, and you can see it right here. Gold per Bitcoin calculated by TradingView, and it's quite significant there. It used to be, what was it? It took about, at the peak there on the left side, around 1,200 Bitcoin to purchase an ounce of gold, and now it takes about 0.16585 Bitcoin to purchase 1 ounce of gold. Significant difference there, 1,200 to 0.16. If you had done that trade, that flip now, you could acquire quite a significant position in gold, even if you just sold a fraction of your Bitcoin. I mean, imagine if you had 1,200, or if you had sold an ounce of gold, let's just put it this way, back in 2011 or 12, you'd sold an ounce of gold, you could have acquired about 1,200 or so Bitcoin, and then today you could purchase quite a bit more. I mean, I'll let you do the math on that. it's quite the leap there if you flip that trade. Prepare for hyperinflation from quantitative easing with prime XBT. Again, I'm not going to, promote either one right now. This is just looking at the information. And again, there's some hard truths here for me to even digest. I remember, I was here with you back in those years. And it's difficult to look back and reflect and realize how economically wrong I was. I mean, I wasn't wrong in getting gold, taking positions there, but how much more wealth could have been acquired by some just if they had taken that risk. And it was a risk and a gamble, because hindsight's 2020. There was no way to really know the future trajectories of Bitcoin, although some pretend today to have known and seen it then, and they did well. Those that did it, they did well. Over time, Bitcoin investors have had a far more substantial return on investment over those who have held gold. Gold has a market cap of over $10 trillion, while Bitcoin's is just over 200 billion. And this is something I've mentioned quite a bit over the years, and more recently in discussing with friends, is looking at the market cap of not only Bitcoin, but cryptocurrencies. It's so insignificantly small, it's incredible. I think the entirety of all cryptocurrencies sits around 400 billion right now. And the market cap of gold being 10 trillion, the market cap of, I believe, the Dow sitting around 27 trillion or so on. And you look at the debts and all the other things. There is a tremendous amount of growth potential in those crypto areas if they start to take an inch into those other market caps and take away from them. There's a lot of growth potential there. If Bitcoin were to grow to the same market cap, the cost per Bitcoin, this is important, very important to check this out. If Bitcoin were to grow the same market cap of gold, the cost per Bitcoin would reach closer to Bitcoin price predictions of $500,000 due to the asset's extremely limited supply. So keep that in mind. And for those that say that's impossible, remember there were people that said 10,000 was absolute, or even 1,000 was impossible. There's people that thought $100 per Bitcoin was impossible. So I'm not going to sit here and say that 500,000. I just can't. I can't with a straight face and sincerity and true, belief tell you that I don't think that that's possible. I can't. I think it is possible. I think that 500,000 could happen. I don't know. I'm not going to say that it can't. Even after 10 years of overperformance, Bitcoin could do 50 times from here, while gold is predicted to at most double or triple in value from current prices within the same time period. Reaching such prices may sound impossible in Bitcoin, but given the global monetary supply of around $95 trillion, and the asset potentially replacing the dollar as the global reserve currency, I doubt that, the numbers are reasonably achievable. Owning Bitcoin over gold has been the better investment in the last 10 years and will only continue. Investors stuck choosing between the two may want to consider the stronger of the two options in terms of return on investment and track record. Gold bugs, like myself, should also consider Bitcoin given its similarities and added benefits beyond what the precious metal can offer. Again, this is just an article discussing preparation for hyperinflation, wealth preservation, currency devaluation, and this author's, obviously he's more slanted towards Bitcoin. That's his prerogative, that's his right. I think there's something to be said for a healthy balance, I do. And a friend of mine recently, like I shared in a recent video, he picked up 1/10 of a Bitcoin. It's the only one that he held, I think, recently. The only one that he's got 1/10. So, and he bought it at around $770. And he's had quite a low return on investment with that, because now that same $770 that he got at some point this year is worth a little over, I think, $1,350 today. 1,300 somewhere in there, almost 1,400. So he's doing well on that. That's it. Hope you guys enjoyed tonight's video installment. It'll air out tomorrow morning. You guys can check it out. Join the conversation down below in the comments. Don't forget to like, share, subscribe, offer your input, join the discussion. Thanks for tuning in to me and Mrs. Maltby, the little sick girl off to my left who's making sniffle sounds. She is getting better. She is healing. She will survive this, and I get to put up with her for hopefully several more decades. All right. You guys take care and be well.